Hi, I'm Mike Helveston with Whitford Financial Planning. Today we're going to discuss achieving financial fulfillment, understanding the impact of taxes. This post highlights Chapter 6 from my book, Achieving Financial Fulfillment. In 1789, Benjamin Franklin famously said, "Our new Constitution is now established. Everything seems to promise it will be durable. But in this world, nothing is certain except death and taxes." Taxes continue to this day to be a certainty of life, so you'd better learn to live with them. Any amount or method of saving for retirement will help, right? Well, you're on track if you are delaying gratification by saving money for the future. Also, many people focus on trying to select investments that will produce the greatest returns over time, which makes sense, of course. However, the asset allocation you choose, which is the mix of aggressive or conservative investments, will likely have the greatest impact on your results. So, if the specific investment you choose won't have as large of an impact as you might expect, what else might? The answer lies in trying to maximize your after tax returns. Would you rather have a 10% return that's reduced to 7% after taxes, or an 8% tax free return? I think the answer is obvious. There are three major types of investment accounts, and they all have different tax treatment. Let's start with tax-deferred accounts. As the name implies, typically the tax on these accounts is deferred until later when withdrawals are made. IRAs, 401ks, 403bs, and most company retirement accounts fall into this category. In most cases, an income tax deduction is allowed for the year of the contribution, and there are annual limits as to how much can be added to these accounts. Next, we have taxable accounts. These are non-retirement investment accounts where what you earn is generally taxable each year. Common strategies for minimizing income taxes include passive investments, such as index funds or ETFs, and municipal bonds, whose income is typically tax exempt. Taxable accounts can be opened as a brokerage account, held directly with a mutual fund company, or through a transfer agent for buying individual stocks. A brokerage account is the most flexible as it allows you to buy and sell a wide range of investment products. Lastly, there are tax-free Roth accounts. Your investment grows in these accounts, Roth IRAs and Roth 401ks, generally tax-free over the years and also when it's withdrawn. There's no income tax deduction allowed for the year of the contribution, and there are annual limits on how much can be added to these accounts. You can also convert some of your tax-deferred accounts into Roth accounts, which includes paying the tax in the year of conversion. This could make sense if you're in a low tax bracket now and expect to be in a higher one in retirement when the funds are used. It's very common for people to simply save money in their company's tax-deferred savings plan and spend everything else, thinking they have done enough. The problem with this approach manifests itself at retirement. Every dollar distributed from a tax-deferred account is usually taxable. If you instead have money saved in a taxable account or a Roth IRA, you should have more flexibility and may have better control over how much you pay in taxes on those withdrawals by being able to choose which account is best. Here are a few other common tax saving strategies. Number one, long-term capital gains. Holding investments for a year or longer, these gains are given favorable treatment over short-term gains where the investment is held less than a year, and those are taxed as ordinary income. Number two, qualified dividends. Many investors like to hold dividend-paying stocks or mutual funds. Pay close attention to the type of income your investment generates. Qualified dividends are taxed at a lower rate than ordinary dividends. For example, many partnerships pay ordinary dividends, which are taxed at your marginal or highest tax bracket. Number three, municipal bonds. Over the years, I've seen many money managers invest in bonds that pay taxable interest for their clients without any regard for taxes, when there may be tax-free alternatives. And number four, look ahead at your income for tax bracket changes. Low income years may be good for intentionally taking on more income. For example, would you pay 12% now to avoid a 22% tax later? High income years should be planned around by taking losses or deductions or deferring income to other years. A great example of this is a Roth IRA conversion. That really shows the importance of planning ahead and understanding the impact of taxes. The main benefit of a Roth conversion is that the money grows tax-free once inside the IRA. The cost of the conversion is that the amount moved is taxed in the current year as income. It will take time to recover from the initial tax bill, but the savings over time can be substantial. Remember, saving money on taxes has the effect of compounding, giving you more to invest. As you can see, understanding the impact of taxes is very important to your finances. For more information, visit us at whitfordfb.com.